If you had to enter a trade right now and hold it for the next 10 bars, would you buy or sell? That simple question defines the most critical concept in price action: always in. The concept of always in is a binary way to look at market direction. It assumes that at any given moment, the market is either mathematically better for bulls or better for bears. If there is no clear advantage, you are in a trading range. Institutions and algorithms are trading every single second. They don't wait for perfect setups. They are constantly adjusting their exposure based on the current price pressure. To trade like them, you must determine who is in control right now. We determine the always in direction to avoid fighting the trend. If the market is always in long, you only look for buy setups. If it is always in short, you only look to sell. This filter drastically reduces bad trades. Let's identify always in long. This state begins with a strong breakout spike. We are looking for large consecutive bull trend bars closing near their highs with very little overlap. When you see that breakout, the probability of higher prices exceeds 60%. The bulls are now always in. Even if the market pulls back, traders will buy that dip because the structural damage to the bear case is too severe. Notice the characteristics of the bars in this trend. The bodies are large, tails are small, and the closes are consecutive. This indicates urgency. Bulls are buying at the market, not waiting for limit orders. Here is a classic example of an always in long channel. After the initial spike, the market enters a channel phase. Although the momentum slows, the bias remains long until a significant reversal pattern forms. In this environment, bear bars are traps. Novice traders see a red bar and try to pick a top, but because the market is always in long, institutions use that red bar as a discount to buy more. Now, let's flip to always in short. The psychology is identical but inverted. We need to see selling pressure that is strong enough to trap the bulls who are holding long positions. That first strong bear spike changes the equation. Bulls who bought the highs are now trapped and looking to exit at break-even. Bears smell blood and are selling aggressively. Follow-through is critical. One big bear bar is a warning, but 2 or 3 consecutive bear bars confirm the always in short status. The more follow-through we get, the lower the probability of a failed breakout. Look at this gap. The low of the previous bar is above the high of the current bar. This gap signifies extreme weakness. As long as these gaps remain open, the bears are in complete control. When the market is always in short, you sell at the market or sell pullbacks. You do not buy. Buying in a strong bear trend is the fastest way to blow up an account, hoping for a V-bottom that rarely comes. However, markets are not always trending. Often, the market is in a trading range. In this state, the always in direction is ambiguous, or it flips back and forth every few bars. In a tight trading range, you will see prominent tails on both sides of the bars and bodies that alternate color. This tells us that limit order traders are winning. Bulls buy lows, bears sell highs. If the always in direction is not clear, the best position is always in out. Stay cash. Or, if you are advanced, you buy low and sell high, scalping for small profits. But trend trading strategies will fail here. The transition from a trading range to a trend is often where the biggest moves happen. We wait for a successful breakout that traps traders on the wrong side. Most breakouts fail, so we need confirmation. Let's discuss how the always in direction reverses. It rarely happens in one bar. Usually, a trend slows into a trading range first, balancing the bulls and bears before reversing. Here, we see a bull channel turning into a trading range. The bulls are losing momentum. The highs are barely higher, and the pullbacks are getting deeper. The always in long status is weakening. To flip from always in long to short, we usually need a major trend reversal. This involves a break of the trend line, a test of the extreme, and then a strong reversal down. Look at this lower high. The market tried to resume the trend, but failed. The subsequent strong bear bar is the signal that the always in direction has officially flipped to short. Once that flip happens, your mindset must shift instantly. You stop looking for buy setups. You accept that any rally is likely a bear flag that will be sold. You must align with the new institutional flow. Occasionally, You get a V-reversal, a violent, immediate change in direction. This usually happens at climactic exhaustion points. These are rare and dangerous to trade without significant experience. In a climax, the last buyers have panicked out, and value investors step in all at once. If you see a reversal bar that is 2 or 3 times the size of the average bar, the always in direction might flip in a single candle. So how do you practice this? Open any chart, cover the right side, and advance one bar at a time. Ask yourself continuously, if I had to take a trade now, is it long or short? If you are unsure, the market is in a trading range. In a trading range, the always in direction is whichever way the market is spiking at that exact second, but it will likely fail. Uncertainty equals trading range. Remember, being always in doesn't mean you must always have a position open. It means you always have a directional bias. That bias dictates which signals you take and which you ignore. By adhering to the always in direction, you align your small retail account with the massive volume of institutional money. You stop trying to stop the train and start riding inside it. A final tip: if you are in a trade and the always in direction flips against you, exit immediately. Do not hope. The math has changed, and holding on is gambling, not trading. Mastering this concept is the first step to consistent profitability. It provides the context for every other pattern we will discuss in this course. Context comes first, patterns come second. In the next video, we will explore specific entry techniques like the high 1 and low 1, which are the precise triggers to enter these always-in trends. Keep practicing your chart reading. Identify the strong breakouts, respect the trend, and stay disciplined. The market rewards those who listen to what it is actually saying. Identify the state, follow the flow, and trade with the institutions.